Hello and welcome to Bazaar Ki Baat. It's our usual market update. Today we are going to talk about two very interesting topics. First, the growing popularity of factor investing, and second, the concept of drawdowns in investing. We have with us Kshitij Jain and Vikas Agarwal, who are going to talk about this individually. In the month of September, equity in India continued to soar. Like we have seen in the last few months, mid and small caps continue to do better than their large cap peers. And this is despite the fact that we have been facing uncertainties in the global market. We have been witnessing over the last few months that even across sectors, there is major outperformance as compared to Sensex. Kshitij, what is your view in terms of what is happening in the markets?
I think September 2023 was an eventful month, especially for the large cap indices. If we take Nifty, it started somewhere close to 19,200 mark and went up all the way to about 20,000. And then it gave up all the gains and I think ended up around just about 2% high. So the major reason for this volatility is that the world at large is grappling with the major uncertainties, largely due to two reasons. One is the sluggish economy or the possibility of the sluggish economy for a prolonged period. And secondly, a sustained high interest rate scenario. So all both of these possibilities, as they are becoming more probable, the world is becoming more jittery. From that perspective, we saw a sell-off across the world, especially in the EM markets. In that context, India also saw a sell-off, but relatively moderate.
So you also mentioned that the world is becoming more jittery. This could be a real dampener for the Indian equity markets also. So what do you think are the challenges that we can foresee or some of the challenges that we are already witnessing in the global markets, especially.
I think the two major challenges which we saw pan out is one, obviously, the Fed hawkishness continues to be a big risk to the global markets. So if the biggest central bank in the world continues to be hawkish, and as we say, interest rates are act like gravity to the equity market valuations. So if they continue to be hawkish for a long time, then we can expect rates to be higher for a long time. And from that point of view, the equity markets may go under that stress. We also saw, on the other hand, political drama panning out in the US Senate, where there was all a possibility of shutdown of the US government machinery, which was extended at the last minute. And then after that, now we saw today that their House Speaker was actually removed from his post because they were not happy with the arrangement. So this drama will continue to go forward, and this is the reason why we saw that Fitch had downgraded US because of these poor governance standards and when it came to the US economy. Yeah, and for
Hmm.
domestically, I think inflation has been a big challenge for India, as it been across the world, especially for India, as we import almost 80% of our oil. The oil prices around the world becomes a challenge, and the oil prices have moved very sharply in the last few months from almost a $70 barrel to $94 barrel in almost 3 4 months, which has put a lot of pressure on rupee and also in inflation. So that will the rates, and hence it will continue to impact our equity markets also.
Hmm. So to basically for everyone asking what's going to happen in the Indian markets, I think a lot depends on what happens to domestic inflation as well as economic uncertainties around the global markets. Let us now move to our first special topic of discussion, which is about the
Yeah.
growing popularity of factor investing in India. We have also seen launches of a few factor indices in India, and which is why we thought that it would be useful for our viewers to understand what the space is about, how does this operate, and how does this really add value. Kshitij, you have been diving deep into factor strategies for the past few years. Before we delve deeper into how do these add values, can you take our viewers briefly through what do these factors really mean?
Yeah, so factor strategies have been becoming popular, and anything which has been popular for a long time, the only reason is that it could have shown outperformance as compared to the existing setup. And that is what the factor strategies have shown, that they've demonstrated long-term outperformance across markets globally. When if you see the chart, this is for the MSCI World Index, which is the market capitalization index for the world markets. Here, if you see all the factor strategies have shown outperform in terms of return as compared to the MSCI World Index, be it any of those momentum, value, all of them have outperformed. And now to come to your point, what are these strategies? Is that the momentum factor, in simple words, is the tendency of a winning stock to continue performing well in the near term. So what it says is that if you take a basket of stocks which have performed well in the past, in the recent past, they will have a tendency to outperform the broader market, or a basket of stocks which has not done well in the recent past. So this is a momentum factor, and this gives an edge to the investor. Secondly, if we come to the most popular method of investing, is the value investing, is that the foundation itself says that you buy something which is cheaper than its inherent value. In a factor terminology, the simpler way to look at it is that you buy cheaply priced stocks, and the basket of a cheaply priced stocks will outperform the broader market, and or a basket of stocks which are highly priced, right? Thirdly, there is a quality factor, which is the, I would say, much simpler to understand, is that you try to buy companies which have durable business models, sustain competitive advantage. I think this is the most difficult factor to actually qualitatively or quantitatively say that this is what I will consider. Everybody differs in their own definition. But yeah, if you buy quality companies, you will most likely outperform the broader market. That's the whole essence of it. The size factor, I think this is part of the academic literature, or and even the practical advisory for a long time. We have been seeing advisors saying that the small caps will outperform large caps. And this is basically the tendency of small caps outperforming bigger companies in the long run. You take a set of small cap companies with a set of filters, then you have a tendency of outperforming the uh, large cap indices. And the fifth would be the growth factor, where we say that you buy companies or expected to grow sales earnings as compared to the average growth in the market at a higher rate than the average, then these set of companies will outperform the broader market. And when this is called growth investing, you pay up for growth. The sixth one, which is the most counterintuitive one, is that the minimum volatility strategy, where if you take a basket of stocks which have a lower volatility than the market, they tend to outperform the broader market. And this is exactly opposite of what we have been studying so far, is that if you take higher risk, you will get higher return. And risk is normally put equivalent to volatility, which is where the problem lies. Risk is not exactly equal to volatility. Risk is much more than volatility. Volatility is just a small part of it. The
Hmm.
real risk is of the capital loss. So this is where all of those factors stand. And when I say outperformance, I'm only talking about long-term outperformance, because all of these strategies will have periods in the short term where they will exhibit cyclical patterns.
Okay. So I think what you mean is that these different factors tend to behave differently during different market times. So can you throw some light on how does the cyclicality that you are mentioning really exhibit itself for each of these individual factors?
Yeah, so see, I think one of the bigger factors is the economic scenario. So to answer that question, we put a chart, and that chart is from a very excellent study done by MSCI, and where they've charted the relative outperformance of various factors across four different stages of business cycle. One is sharp decline, moderate uptake, and sharp uptake. Across these four, when you categorize the factor, there are three broader buckets. One is the defensive factors. So, as the name suggests, these are the factors which will do well during macro downturns, right? The quality, yield, and minimum volatility. The simple reason is that these factors will not fall as much as the broader market, and so they will outperform. Where they'll do well in turbulent markets, serving as a means of capital preservation. Then there are factors which can be classified as persistent. Momentum is one such factor, which basically does well when the macro environment is stable. So when there is stability, it will outperform the other factors. When I'm saying it does well in stability, I'm not saying it doesn't do well in other scenarios. I'm only saying that it outperforms others when there is stability. It may do well in other scenarios also, but when there is stability, it outperforms others. And the third one is the pro-cyclical factors, which is the value and the size factors, which do well when the in a rising macro situation. And we have seen this play out so beautifully in India. If you see there are contrarian mutual funds and value oriented funds which have done so well in the last 2 3 years, where we are seeing a macro uptick in India. We are seeing both these pro cyclical factors doing well, which have not been doing so well when the market was under a bit of a stress or macro situation under a bit of stress. So having said that, individually they tend to perform or underperform in different market scenarios. What an investor can take out from this is that there can be situations where you can link these two and gain from diversification benefits. We will probably look at it in the next month's presentation, because these factors have some of these factors have negative correlation with each other. So the idea is here from this point is that the goal is not to time these factors. What we are trying to say is that once you invest in a certain factor strategy, you can understand the reason for it underperforming in a certain macro scenario. So that's what I would
Right.
probably say that
Right.
should be the takeaway.
That's a very, very valid point, Kshitij, because what usually happens is, as layman investors, we've heard about value investing, even growth investing, to some extent, quality investing as well. But as an investor, when I talk to people and they evaluate their portfolios, they compare fund A to fund B, and with this knowledge, I think we can have a better view in terms of why something is doing well and why something is not doing well, and under what circumstances could something really start outperforming. So I think that's very, very insightful. Thank you so much, Kshitij. And with that, we will move to our second special topic for the day, which is about drawdowns in investing. And it's a very important topic and a relevant topic, not because we are in market highs, but this is a term which we use very commonly in the world of investing once we enter into bear markets. So I would now invite Vikas to briefly first tell us what does drawdown really mean in a very simple manner.
Hi, Shruti. So, yeah, drawdown. Actually, this is sometimes ignored by a lot of investors because the predominant focus always is return. So, most of the people I know, they filter down funds from last 5 years return and then or 1 year return, and they decide on their investing journey. So, I thought that let's discuss drawdown today. So, drawdowns in investing actually is there are whenever you do an investment, it has a historical track record, and the peak value, like the highest NAV, like we say net asset value of an investment, is called the peak, and that from that peak, the lowest that it has fallen ever is called the through. So the difference between the peak and through is called in percentage terms is the drawdown. So drawdown helps you know that if you invest at the peak and if it goes to its lowest value, what is the maximum loss that you can see in your portfolio. Drawdown calculation has two aspects. One, you need to know what is the max drawdown, that what is the maximum you have seen this peak to through, and what is your current drawdown. So maybe the current drawdown is lower than the maximum drawdown. So this helps you understand that what is the actual risk that you're taking in your investment.
Right. Can you explain this through an example,
So we
Vikas?
have
I see that
also
you've put a
done.
chart here.
Yeah, so we have done a very small calculation so that you can actually understand the concept. So what I have taken is that I've taken 100 rupees as your starting capital. And if you make 100% returns in the next year, your capital grows to 200. You've made 100% return. Since we have not seen any like drawdown or any kind of loss in your portfolio, the maximum drawdown and current drawdown is 0 in the first year. But what happens in the second year is that you see that your portfolio loses rupees 50 in absolute value. So there's a loss of 50 rupees, which means that you have lost 50, which is 25% of your capital. So this 25% is your maximum drawdown till now because we are in the second year. And this is calculated, as I told you, that the peak of the portfolio is 200 and the through, which is 150, is the lowest that it has attained. So the difference between the two in percentage terms is max drawdown. Since this is the second year, the current drawdown and max drawdown are the same. When we move to the third year, we see that the portfolio value goes to 250. So we have taken a return of 67%. Since again the portfolio has not seen a drawdown now, so the current drawdown is 0. The max is 25 because it has reached a 25% kind of loss in the last 3 years once. Now when we go to the fourth year, what we see is that the portfolio value goes to 200. So again we see a loss of 20%. Now this 20% becomes your current drawdown. And since your current drawdown is lower than your maximum drawdown, the maximum drawdown remains the same. So this is a simple chart which you can follow to understand what is drawdown on your portfolio. And whenever you're taking an investment decision, you should know that what is the maximum drawdown your investment option has ever seen in the tenor of its
Right.
investment.
So what I understand from this chart is that drawdown essentially means that how much of my portfolio had achieved in gains, and from there how much I have come down in terms of the losses that I've seen due to any fall in the markets. But despite these numbers being random, because what I see is that the ultimate CAGR on your portfolio still looks pretty decent even in the years that there has been a drawdown. So then if our returns are okay, why is drawdown as a concept so important in investing?
Yeah. So see, drawdown, like this is one example that we have seen is of ARK. But before that, I'd like to discuss something else about drawdown. There's one more peculiar thing about drawdown. When the drawdown actually hits your portfolio, and if it is a significant part of your investment, you behave quite differently. And what we have seen across market cycles is that a 10 to 20% drawdown is quite common in equity. A 30% kind of drawdown also happens once in 10 years. But beyond that, a drawdown of say 40, 50%, this is like you may see that kind of thing happening in 30, 40 years. So in the last example, we have taken only a drawdown of 25%, which is a very manageable drawdown. So what I mean is that if you see any equity investment or any kind of investment which has a drawdown in the range of 10 to 20%, or even if it is below 30%, you should be okay, because this is not something which is an exception in like markets. This is which happens like in once in 10 years. So if it is below 30, you should not be that worried. But if you see any investment which is a drawdown of more than 30%, then actually the drawdown starts impacting your CAGR over the long term. So to explain this more, we have one live example, which is of ARK. This is an ETF which is being run by Kathy Wood, and this was there was a lot of like interest amongst investors for for this particular ETF because of the returns. I had like a couple of my friends who had called me that why are you not investing in this? Like when I told them to invest in S&P 500, they were saying that why are you investing in S&P 500? You should invest in this ARK ETF. But when you see this chart, you realize that in the from 2021, it has seen a drawdown of 75%. This 75% drawdown is massive. And if you are invested at the peaks or closer to the peaks, there's a lot of road to recovery for you. So you have to be very, very wary of any product which has a drawdown of more than 75%. So we have done a small calculation that like now somebody who has invested in 2021, how will he see his investments grow? So again, to this chart, like we had what we had earlier discussed, that like from 10 to 25%, you can easily see that the drawdown is quite manageable. So the road, like the returns required to break even is manageable. But beyond that, if you see a 50% drawdown needs 100% return. So if you remember in the last presentation, we had talked about rule of 72. So if we just apply simple rule of 72 over here, which means that if you have seen a drawdown of 50%, and if you have to double your capital, you will need 15% returns for 5 years just to come back to your capital. So if you just simplify that rule, so you know that just to come back to capital, you need 5 years and 15% CAGR. So this is again another example that we have taken. This is an example which is trying to show the returns of that ETF which has fallen by 75%. If we see this example, we see that the drawdown was 75%. So your 100 invested goes to 25. Now, even if you generate 15% returns for next 20 years, which is very, very difficult. Like if we know that as the tenor of your investments increase, the higher returns are very, very difficult to be generated. And if you had invested 100 rupees, the total return is so one has to understand how does drawdown impact your portfolio is my humble submission.
So my takeaway from this example of ARK that you have given, Vikas, is that even if you have a very decent road to recovery kind of a return trajectory, a very heavy drawdown can still make your overall portfolio return look very, very low. So this gives rise to two very important questions at this juncture. One is, given the current market levels at which we are, does this mean that investors should exercise caution of entering into the markets? Because if we are near the peak levels, we could see massive drawdowns. And second, for those investors who have already are sitting on huge gains, should they book some profit and come into, let's say, an alternative category to minimize the fear of drawdown and wealth erosion that might happen in the future?
Yeah, so for your first question, what I feel is that if suppose there is any product which has a drawdown of more than 50%, you should actually avoid that kind of product, if you ask me. And even if you want to do it, you should do it with a very, very small amount of capital. And the other thing is that if you have a product which has a higher drawdown, you should always you should always deploy asset allocation. So if your that product is now a significant part of your portfolio, you need to come back to certain products which are less risky, which see less drawdowns and market correction. So asset allocation is one of the foolproof ways to play these kind of investments with keeping the risk at check. But yeah, any product which has more than 50% drawdown, I think it cannot form a big part of your portfolio. And if it cannot form a big part of your portfolio, it generally does not move the needle. And coming to the present small cap scenario, so what I am seeing is that clients who are heavily invested in small caps, they have seen that their asset allocation towards small cap is now on the higher side. So it has tilted towards the small cap side. So they can easily book some profits and come to large caps if their horizon is higher. And if say suppose they want to if their goals is nearer, they can even book and come to debt funds. So definitely if your asset allocation has changed in favor of small caps, you should book some gains.
Right. Right. I think this was a very, very interesting point because definitely small cap as a space has been garnering a lot of interest, and a lot of new investors also tend to get lured by all the high returns that they see in the last few quarters. So thank you very much. I think it was very, very insightful. And thank you to all our viewers for watching this episode, and stay tuned for the next one.